Welcome back, MTG Tribe, to another insightful Morpheus swing trading video. I'm Deron Wagner, your guide to navigating the ever-changing currents of the market. In our previous video, we looked at how the Nasdaq was flirting with its 50-day moving average, and since then, crucial support of that indicator gave way, leading to a downward momentum shift. Now, the benchmark S&P 500 index has followed suit, slicing below its own 50-day moving average for the first time in 5 months. Today, we explore the implications of these pivotal technical shifts and what it may mean for the market's trajectory and the potential direction of stocks. Join me as we dissect the charts of both the S&P 500 and Nasdaq to gain valuable insights that can inform your trading decisions. We also circle back to Celsius, a breakaway gap winner, to assess how it's been performing since our last update. Finally, we shine a spotlight on Booking.com, a stock that's been standing strong amidst the turbulence, a true testament to relative strength. Don't forget to hit that like button if you find this information valuable, and make sure to subscribe for more insightful content. What is going on with the Nasdaq? This is a daily chart of the Nasdaq 100 ETF, QQQ. Last month, we see after a multi-month uptrend that QQQ entered into a short-term correction mode and sliced below support of its 20-day exponential moving average on August 2nd. And just 1 week later, after being able to get back above that moving average, the price action came into the 50-day moving average. Now, the 50-day moving average is a crucial indicator of intermediate-term trend that often sparks a significant rally when prices come into that level. In fact, when you've got a strongly uptrending leading stock, the first pullback that touches the 50-day moving average is often a relatively low-risk buy signal that attracts investors and institutions alike. However, that's not what happened this time. This time, the price tried to bounce off the 50-day moving average, but the bounce was short-lived. You notice what happened here the next day after we tried to bounce. The price ran into a multitude of resistance. First of all, we have this short-term downtrend line that had developed, and that acted as resistance. And also, the price action stalled when it tried to get back above that 20-day moving average. So this is a great example of one of the most basic tenets of technical analysis, and that is that a prior level of support becomes the new level of resistance after the support is broken. So notice how the 20-day moving average acted firmly as support during the uptrend, but now it's acting as resistance. So when the price tried to get back above and bounce off that 50-day moving average, the combination of the 20-day moving average, the 8-period moving average, and the downtrend line was too much, and the price action sliced below the 50-day moving average the next day. Now, often we'll get a one-day undercut below a key level, and that's actually what happened here back in, back in March. We tested the 50-day moving average, dip below it one day, and snap back above it the very next day. And that's often what we see, but that wasn't the case here. The price did try to snap back above that 50-day moving average, but once again was met by convergence of the short-term downtrend line as well as the 8-period moving average, and there just wasn't enough momentum to push through. The very next day, traders sold into strength of that bounce, and prices closed at the low of the day on higher volume, I should add, and yesterday following through with another day of selling on higher volume. So this higher volume is key because when we see higher volume selling, that's a sign of institutional selling, which is also known as distribution. And that's a bearish sign for the current trend of the market. So we don't want to see higher volume selling, but that's what we've seen the past several days. So if the Nasdaq 100 continues lower, where will we find support next? We may find some support around the 357 level, which is a level of horizontal price support. You can see here where we circled those levels where it marks to a line around 357. So that's about 1.5% lower than the current price. If that level fails to hold, then we've got much more significant support of the dominant uptrend line, which actually originates back in January. So this uptrend line has been in place now for 8 months. So a move down to this trend line could definitely spark a rally, but obviously that's quite a ways until we get there. So one day at a time. And most importantly, we trade what we see, not what we think. So this is just one possible scenario, but anything can happen in the market. We want to be prepared for any scenario. So this is where we could look to find support. If the market does try to rally in the next couple of days, of course, we've got the same resistance levels. We've got this short-term downtrend line. Also watch the 8-period moving average, which is currently at 368, with the 50 and the 20-day moving averages just overhead. So until we get back above the 371 level, there's a significant level of resistance, and the momentum does favor the bears in the near term. Next, let's dive into the chart of the S&P 500 Index ETF, SPY. And SPY has been holding up better than QQQ until recently. And when the Nasdaq had first touched its 50-day moving average, the S&P 500 was still holding above its 50-day MA, but it had slipped below key support of its 20-period moving average. And now, unfortunately, the S&P 500 has joined the Nasdaq in breaking below its 50-day moving average just yesterday, selling off on higher volume for the past 2 days, just like the Nasdaq, and now firmly breaking below that 50-day moving average. So where is next support for the S&P 500? Well, we will find some support right around the 431 level, which you can see is the prior lows here from June. So we could see a little bit of a bounce there if we get down to that level. Much more significant support, horizontal price support, is found all the way down around the 418 level, which is a significant area of prior highs. Again, prior resistance now becomes new support. Below that, we've also got a similar uptrend line, just like the Nasdaq has, going back to beginning of January. And we actually see that this trend line is going to be converging here real soon with this horizontal price support. So that means that the 418 level is a major level of price support. Now, will we see that level? Who knows? It's anybody's guess. But if prices continue lower, this is definitely a major level of support that you want to keep an eye on. If we break below, of course, if we first break below this 431 level. If the S&P 500 attempts to rally and reclaim its 50-day moving average, notice that the 50-day moving average also converges with resistance now of these prior highs from back in June. All right, so when we broke above those highs, that level became support, which converged with the 50-day moving average. But since it didn't hold, we've now got convergence of resistance right around the 444 level. So that's a really important level, the 444 level. We may have some trouble getting back above that level unless we see a volume surge, which would be bullish. If we can reclaim that level, close above it on strong volume. If we do get above that 444 level, keep in mind we've got the 8-period and the 20-period moving averages acting as resistance as well. And we also have a short-term downtrend line that's formed here, which I didn't draw. Overall, short-term momentum has shifted in favor of the bears. So we'll keep an eye on the situation and continue to keep you updated in our videos. And if you are a subscriber of the Wagner Daily, of course, we'll keep you updated every day with our hot commentary in the Morpheus Swing Trader chat room. In our last video, we showed you how Celsius, CELH, had just formed a breakaway gap after a strong earnings report. And we said that the breakaway gap is one of our favorite setups in the Wagner Daily service because the breakaway gap can often lead to big gains of 20 to 40% in a short period of time. But it's important that you have a strategy for entering the breakaway gap in order to have relatively low risk. We said in our last video that there was 5 ways to enter the breakaway gap, and we shared a link to the blog post, and I'll go ahead and share it again in the comments section. Go ahead and check the comments if you want to learn how to enter the breakaway gap. We wrote a full blog post about the 5 ways to enter it. One of the ways to enter the breakaway gap is the first pullback that touches the 8-day moving average, which is right here, this green line, currently right around 171. So if we get a pullback in the coming days to this 8-period moving average, CELH could be in play for potential swing entry in anticipation of another leg up. CELH has been showing incredible relative strength, just consolidating at its highs, completely ignoring the fact that the S&P and the Nasdaq broke down below their 50-day moving averages. This is a great example of relative strength, and this is one of the hallmarks of the Morpheus swing trading strategy. If a stock is so strong that it continues to consolidate at its highs, even while the rest of the market is breaking down, guess what happens when the rest of the market eventually bounces? The price shoots higher and breaks out to new highs. It becomes one of the first stocks to rally and lead the way higher. So if the market does continue lower, CELH will probably eventually feel that pressure and move lower. But given its relative strength, this is definitely one of the better setups in the market right now. Note that CELH has moved about 5% higher since we first mentioned it in last week's video. So kudos to those of you who read our blog post and found a valid entry point on CELH. If you haven't gotten it, again, look for a potential pullback to the 8-period moving average. Finally, Booking.com, BKNG, is another stock showing incredible relative strength, just consolidating near its all-time highs, completely ignoring the market, and maybe pulling back here to its 8-period moving average. Now, in this case, it's a little bit different setup, so we wouldn't necessarily just buy this pullback. We'd rather see a deeper pullback, such as the 20-period moving average, and then a bullish reversal back up. Members of the Morpheus chat room can keep an eye out for our trade alert if we spot a potential buy point in BKNG. Nevertheless, BKNG is just a relative strength leader that you definitely want to have on your watch list, looking for low risk entry points. Don't chase breakouts. If you miss the breakout, obviously wait for the pullback. That's really important, especially in a weak market. Now, what do BKNG and CELH have in common? Both of them are at all-time highs. And that's really crucial because a lot of new traders are afraid to buy new highs. I know when I was a new trader, I thought, well, it's already gone up so much. I don't want to buy it because I'm too late to the party. But ironically, stocks at new highs are the ones that continue much higher simply because there's a lack of overhead resistance. It's blue sky. There's nobody that bought at a higher price that's looking to sell when the price moves back up. So that lack of resistance means it doesn't take a lot of buying pressure for the trend to continue higher. So this is one of the reasons why the Morpheus swing trading strategy constantly focuses on stocks that are breaking out on strong volume to new highs, also looking for strong earnings growth as well. We hope you enjoyed today's video and found it insightful. If you're new to Morpheus and would like to find out more about our swing trading services, head on over to morpheustrading.com. Drop your email on the forum to receive daily swing trading ideas and mini lessons, and press on stock picks to learn more about our exclusive Wagner daily swing trading service, which has been in continuous publication since 2002. Have a great day, and we'll talk to you again soon.